Hey y'all, this is Rich with Cross Country Mortgage. So Friday, SVB, Silicon Valley Bank, went under. The feds took them over. And what's really going on? What happened? And is this indicative of a bigger issue? Normally, I don't do videos on Sunday, but I thought that this was a big enough market mover that we had to address it. So, why did Silicon Valley Bank go under? Was it making risky loans? Was it doing subprime mortgage lending? No, no, it wasn't any of this stuff. Here's what was happening. Silicon Valley Bank was a bank that was doing a lot of tech, a lot of startup type banking. So a lot of these companies that were banking there, they were trying to get the highest yield for their deposits. Also, because it was more startup and more tech, and we've seen a lot more layoffs in tech, and a lot of folks with the economy slowing down and the Fed increasing rates, what they've seen is that more people are withdrawing money, their cash that they have at the bank, rather than taking more loans or borrowing more because borrowing more costs more in this high rate environment. So, what do banks do? When banks get your money, they want to make some sort of spread on it. So they're going to invest it in secure assets like 2 year treasuries, 1 year treasuries, mortgage backed securities. Well, let's take a look at what would happen if Silicon Valley Bank had invested in a 2 year treasury 1 year ago today. 1 year ago today, that 2 year treasury would have had a yield of just under 2%. Okay. The interest rate that it would be paying is just under 2. As of Friday, or Thursday, that same 2 year treasury had a yield of just over 5%. That's a 3% difference for all of those at home keeping score. Now, if there was 1 year left on that treasury and they had to sell it to get the money out, they would essentially be selling that treasury, to simplify it, for about 97 cents on the dollar. That means that for every dollar in those 2 year treasuries they sell, they're losing 3 cents. Back at the end of 2022, according to David Stevens, who is really, really knowledgeable in the mortgage space, he has been the head of the Mortgage Bankers Administration. He has been involved in the mortgage industry. He was pointing out that Silicon Valley Bank had about 117, I think it was, million in these securities. And if they had marked them down to market, they were really worth about 90 million. But they held them as assets to be held to maturity at the end of last year. So they really weren't showing the loss. Because they weren't showing the loss, when it came up time for their investors, their depositors, to come pull the money, they didn't have the liquid funds. They said, hey, we've got this problem here. And then they went to raise capital. Well, wait, we've got this problem. If any of you guys have seen It's a Wonderful Life, you may remember the run on the bank on Bailey Building and Loan. This is a similar situation, but we didn't have Jimmy Stewart as George Bailey there to help bring calm to the market. So what ended up happening was you had all these people coming in trying to get money out. They were selling these securities below the par rate, so they were losing money with every sale, and 60% of their deposits ran off. That's unsustainable. Now, this is the 16th largest bank in the country, not too big to fail. It's not that they're making bad loans, but they didn't have any sort of, or an effective enough interest rate hedge on the securities that were backing up their deposits. Are we going to see more of this? There are probably some other banks that may be not sufficiently hedged. We're going to see stuff shaking out over the next few days. One key thing, the Fed has called an emergency meeting for tomorrow. So, a couple of things. One, we're probably not going to see a rate hike. We might even see a rate cut because the Fed's hyper aggressive quantitative easing, where they were flooding the markets with dollars like using a fire hose, and then the quantitative tightening that they did extremely rapidly over the last year and a half is essentially what caused this issue. You had this huge free flow of capital coming into the market, and then not only did they shut it off, but they opened the drain. And they were taking money out so rapidly, and they were increasing interest rates so rapidly that you see our inverted yield curve that we have right now, and you see what has happened to the yields that's putting stress on these banks. So even though the bank may have been acting responsibly in how they were investing the depositors' funds, at the end of the day, they got caught holding the bag. Jerome Powell and friends said they wanted to break something. Well, hey, guess what, guys? You freaking broke it. These guys are absolute maroons. Let's hope that they don't do something stupid tomorrow. We'll let you know. If you got any questions, give me a call.